Welcome to our channel. This channel deals with the fire journey of a family. Our net worth goal is $5 million. So this is our allocation goal in retirement: bonds 20%, cash 5%, and stock market 75%. The reason for this is there are many studies and YouTube channels out there I won't bore you with, but this is where we feel comfortable in a long-term growth, but some rainy day funds in the form of cash and bonds.
And this is our current high-level portfolio breakdown. We are working on reducing some of the individual stocks and moving them towards bonds. And that's why you see the cash a little higher as we're purchasing bonds and rebalancing from stocks.
Individual stock breakdown, very tech heavy as you can see. And a more detailed view, as you can see, Microsoft and Google are heavily skewed, with the rest pretty evenly distributed. We are looking and selling those based on tax loss harvesting. Index fund is mostly S&P 500 with a few energy related and food related index just to distribute our index fund portfolio.
And these are bonds. So the bonds are very low risk or low boarding, lack of a better word. Gold, we consider part of bond. It's something that's very like stable. It won't crash overnight. Uh, and most of our bonds are being transitioned to be held as part of the U.S. Treasury, like their actual website, not via any brokerage. The reason for that is the rates are very good. We had a few index funds that like bonds index fund, BND, etc. All of those. We saw the rate of returns of them was not worth it. We invested in a few company type bonds and municipal bonds, but again, we saw like risk reward, it's not there. Like the 0.2%, just not worth it for us. Where we are, sort of like this close to retirement, we more want to preserve our capital. And so there's some limitations insurance wise, Fidelity, Schwab, all of those guys. Um, they're not like insured for the whole amount, especially in large amounts. They're insuring like a certain portion of it, and they're insuring against their own bankruptcy. So this is not the stock going to zero. This is more like the management company is going to zero. So that's why we move some of our things into U.S. Treasuries, like directly handled by the U.S. government. So that's covered by 100%. So if the U.S. government goes bankrupt, I think we'll all be in a lot more trouble. So we're okay with hedging our bets against their system. They have a crappy UI. It's very hard to do things and move things around. But for holding bonds, and we have two, three, we have some I bonds and some 10-year bonds and some 30-year bonds. So all around, sort of like diverse sort of bonds portfolio. Some of it to adhere to the bucket strategy, some for delayed um, taxes, that sort of thing. We also hold some bonds for our kids. These are not tracked here, the bonds for the kids, but we also it's part of their portfolio, sort of like long-term stability.
Unrealized gains, we're tracking that as well because of the taxes involved in selling them and when. So it gives us a better overview of how our portfolio is structured when we move over towards the depletion portion versus the earning portion of our fire journey.